Hello students, this video is about chapter 15, Investment Time and Capital Markets from Microeconomics Pindike. The idea in this chapter is about how businesses make decisions in investing in a certain productive venture. So in simple language, it means that a firm wants to know what is the value of an expected profit in the future in today's money. Okay, so that when they make an investment, let's say of 10 million to open a factory, will their return be more than 10 million in today's money? Yeah, of course it may be more than 10 million in future value, in future terms money, but what is it worth compared to the 10 million? Yeah, today, what is the value of that money in today's terms? Okay, so before that, we take a look at the meaning of stocks versus flows. This is actually very fundamental in microeconomics. Stocks are the capital assets that you have at a certain period, at any given period of time. Okay, and you accumulate a capital stock or your capital goods. Yeah, whether it's machines, whether it's factories, whether it's lorries. But flows are the expenditure that you make per unit of time. For instance, you pay wages 1 million in total per month or per year, for instance. You receive revenue 8 million per year. So therefore your profit is blah 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 per year, okay? So or per month. So this kind of expenditures, this expenditure is considered flows. So you have stock versus flows, right? Okay, so coming back to the question we asked earlier, how much is a profit that a company expects to make in a year or 2 years later down the road? How does it compare with the money that they are using now? Okay, compare with the current outlay, we call it, yeah, the investment outlay. So since money, yeah, the money has opportunity cost. So $1 today has opportunity cost. If it is used in this productive venture or this business, you will lose the opportunity to earn interest on the money if saved as a deposit or an investment in another productive venture. Okay, so this is the income foregone opportunity cost. Or if that $1 is money that you borrow in order to start this business, then it will be the interest paid. Okay, or we call it the cost of fund. So either way, whether you are using money that is in another productive venture, or you are borrowing in order to start this productive venture, this $1 has opportunity cost attached to it. Okay, so in 1 year, what is the value of that money? If 1 year is paid, if $1 is paid after 1 year, so that $1 paid will be the future value. Okay, but we want to know what is the present discounted value of that $1. So what we do is we discount it with a discount rate, okay, which is called R. So all the future value, all the $1 of the future is discounted, yeah, so that you know its value in today's terms. But if you're looking at 2 years, then you discount it with with index 2, yeah, or 3, and so on. Okay, so $1, the future paid in the future, is now worth 1 divided by 1 plus R to the power of N. Yeah, this is the present discounted value today. So you will see the role of R just now, the interest rate or the discount rate. If you choose a high discount rate, that means you believe that the opportunity cost is high. Yeah, every year the value of money changes very, very significantly. And therefore, if you want to take the future value and work backwards to find its PDV or the present value with the high discount rate, then the PDV here will become very small. Because you use a strong discounting power, a strong discounting coefficient there. If you believe that the R should be high. Okay, but if you use a small r, that means the value of money or the opportunity cost is small. So when you work backwards from this future value, $1, work backwards to the PDV is relatively still large. Yeah? Although smaller than $1, but it is still strong. So let's look at this table. For instance, you start with 0.05, which is actually 5% discount rate. Yeah, 1 year the value reduced to only 95 cents. 20 years is 37.7 cents. But if you take a higher discount rate and you discount backwards, so first year it's 83 cents. After 1 year, yeah, with 20% discount rate, your $1 is actually 83 cents in this year's money. And in 20 years money is 2.6 cents. It's not even 3 cents. Okay, so there's an inverse relationship here, that the higher the interest rate or the higher the discount rate, the smaller the PDV. Okay, you can check again this one. The smaller the discount rate, the higher the PDV. Okay, so going back to the formula just now, if you were to use 5% in this formula, in any of the formulas, you'll find that the value is always larger, the PDV is always larger than if you use R 20% versus R 5%. Okay, now let's add another layer of complexity. Let's say we give you an option of paying the business in 2 streams of payment. Yeah, the first stream A, is that the business is paid or receive income 100 today. Yeah, therefore need not to be discounted at all with R or any R, and then 1 year they will receive 100. So this one will be discounted. Another option is to receive payment under stream B structure, which is $20 today, no need to discount, and 100 in year 1, 100 after year 2. So stream A payment will look like this. When you want to, stream A's PDV will look like this: 100 plus 100 over 1 plus R to the power of 1. Stream B PDV will look like this: 20 plus 100, 1 plus R, to the power of 1, plus 100, 1 plus R to the power of 2. Okay, so this is the stream of payment. Now we need to choose the R, or the discount rate. So table 15.3 shows that if your R is 5%, this one, PDV of stream A 195, PDV of stream B is 205. So stream B is much more valuable. If you use a discount rate of 20%, stream A 183, stream B 172. So stream A is more valuable. So in other words, what is better for you in terms of the PDV of your future income stream depends on the discount rate that you need to apply. Okay, and it also depends on the initial amount that you're receiving that is not discounted. Okay, we already said earlier from the previous slide that the smaller the discount rate, the higher the PDV. Correct? Yeah, here. The smaller the discount rate, the bigger the PDV. So the larger the discount rate, the smaller the PDV. Correct. But what makes the difference, the additional difference here is that the initial 100 that need not to be discounted at all in stream A makes stream A much more valuable than stream B, which is where you only have $20 in front and the rest will have to be discounted. So that's why in this instance, stream B is not that attractive. It has a high a high discount rate, and it also has a small initial value in the long run, right? So I hope you can look again at this comparison, and you can even test the calculations in your financial calculator. I'll see you again in the next video.